audit review second quarter financial report. PFM consultants, they're here to give us a presentation on. Go ahead.
We handed out paper copies, and I think it'll be up on the screen. So you'll notice that we have a new look for our quarterly investment reports, and I'll kind of point out some of the new features as we walk through it. The market update is a little bit longer than I'm going to present. As probably everyone heard, the UK decided at the end of June to leave the EU. The media termed that Brexit. And although it had pretty widespread impacts in the market, those impacts were fairly short-lived. We've done a lot of recovering very quickly since then. And there's a lot of material in there about it because it was sort of a big event, but I won't go through it all page by page.
Sure, thank you.
So, you know, the EU is an organization of about 20 or 23 member countries in Europe, the UK being one of them, and there was a referendum on the ballot in the UK as of June 23rd, and the UK decided to vote to leave the EU. And that's probably going to take about 2 years. It was a very unexpected outcome, which is why we saw such an overreaction in the markets, and I'll show you what I mean by that in a few slides. But, you know, the real impact on the agency's portfolio has more to do with how does that cause the Federal Reserve to think about raising rates. And on the right-hand side of this page, what I've provided you are the probabilities of a Fed rate hike at each of the upcoming Federal Reserve meetings. The July 27th meeting has obviously happened now, but as of points in time. So as of the end of last year, as of May 31st, because that was just after the Federal Reserve released their April minutes, which were fairly significant, and then as of July 8th, so post-Brexit.
What is this, the probability of a Fed hike based upon?
It's based upon the Fed funds futures market, so where investors buy contracts for where they believe the Fed funds rate will be at a future point in time. So as of the end of the year, you know, the Federal Reserve is giving strong indications that they thought they would raise the Fed funds rate 4 times this year. That was probably very optimistic on their part at the end of the year. And you know, the probability of a rate hike has come down throughout the year. You know, rates fell off right at the beginning of the year, given the volatility coming out of China and with the oil markets. And that kind of volatility has continued. We saw rates continue to fall through June, really throughout the whole second quarter, and rates ended quite a lot lower. And you know, rates give us an indication of what the market thinks is going to happen in the future. And so rates falling is an indication that the market thinks that the Fed's not going to raise rates. You can see the May 31st percentages are a lot lower than the December 31st percentages. That was because, you know, the Fed indicated they were on hold their March and April meetings. But then when their April minutes came out, which give you much more intelligence on what they were actually talking about at the meeting, the April meeting details were much more in line with them looking at raising rates sooner rather than later versus the April statement, which is that public statement they released the day of the meeting. Really didn't give any indication of that. So those 2 reports on that same meeting had very different messages, which was kind of interesting. And that's why, you know, before May 31st, those numbers were actually quite a lot lower, and they were higher by the end of the month. And then if you looked at these as of June 30th, they were basically 0 for the rest of the year. And as I said, we've had some recovery in kind of the expectations, yields, equity markets, what have you. And so I'll show you a little bit of that. So just to talk about a little bit more about the EU, what it is. The EU has the size in terms of GDP about the same size as the US in terms of economic growth. The United Kingdom was a pretty significant contributor to that with $2.8 trillion of GDP itself. You can see Germany, United Kingdom, France, and Italy are starred because they are all in that first $16 trillion bar for the European Union. So it's not an insignificant event to have the UK decide to leave the EU. In the upper left-hand corner, I'm going to focus on that impact on equity markets. So, you know, the first business day after this event happened, we saw equity markets around the world really taking a dive, just as investors became much more, you know, down on the prospects for growth in the rest of the year. And then that really quickly bounced back. And, you know, the S&P, even just a week later, you can see it's that far bar on the right-hand side of that chart, you know, big pickup domestically. And over the last few weeks, we've been hitting record highs in the S&P 500. So nobody seems to be worried about Brexit at this point or going forward. And, you know, it remains to be seen how it's going to play out. There is the expectation that the UK could see some much lower economic growth, could see a recession, and we could see some of that, you know, sort of dampening of economic activity spilling over globally. We expect to see no more than 0.25% to 0.5% of that here, but you know, that'll take a while to play out. That's not going to be a near-term impact. One of the sentiments that, you know, we have in investing these days, particularly in the short-term fixed income area, is that yields are very low, and you know, that's not great for generating value. But if you look relative to sovereign bond yields around the rest of the world, yields in the US are actually quite high. And one of the reasons for that is because the US economy is a lot healthier than other economies around the world. And so we have a lot of demand, you know, for our bonds. And that is actually, you know, the extra demand is
way to get out of it.
holding yields down actually, but we're seeing negative sovereign bond yields in lots of the world. Those are all those red bars up on the chart, which is, you know, pretty counterintuitive in the fixed income world. There's you know, some real difficult implications when you have negative yields, but luckily we're not experiencing that in the U.S. So even though Brexit was a really big event that happened at the end of the second quarter, I will just point out with these charts here on page 6 that if you look towards the right end of each of the charts, we've circled kind of what the Brexit impact was on, you know, the Chinese stock market, the U.S. stock market, the oil market, and the 10-year U.S. Treasury. And if you look back a couple months and look at the beginning of the year, which is sort of the beginning of those yellow shaded areas, you can see that the volatility that we saw in the market due to the slowdown in the Chinese economy and stock market and oil prices was a lot more, it was a lot stronger volatility than we had because of Brexit. So, you know, we had a quick turnaround, and the sort of declines that we saw in the various indices was less than we saw in January. I mentioned that yields fell. Yields have been falling throughout the year. You know, we were in a rising interest rate environment at the end of 2015, and we gave all or more of that back year to date. The blue line to the gray line is the first quarter, that's December to March. You can see there was really a shift in the shape of the yield curve. We gave up some of the steepness that we had out in those longer term investments. And then quarter over quarter, March to June, that gray line to the orange line, we basically had a decline, a parallel shift downward across the yield curve for the most part. And then you can look at the right-hand side and see what those yields were. So we started the quarter at 0.72% on the 2-year and ended at 0.6. And as I said, we've had a lot of recovery pretty quickly. So the 2-year yield is back up in that 70 basis point range today. I mentioned before that the U.S. economy is a lot stronger than other economies around the world. Just a quick snapshot of what we're seeing. We had over 1% growth in the first quarter. We also had, which is not shown on here, 1% growth in the second quarter. The second quarter was pretty disappointing. We're kind of used to having slow first quarters because that's been a trend over the last several years. But having the second quarter come in at 1.2% was lower than expectations. It was down because of slower than expected business spending I think, you know, the economists are really hoping to see a 2 handle on that number and a 2 on average for the year. But we'll have to see if that gets revised up in the subsequent reports. We had good employment over the quarter and for the July report. May was a little disappointing with only 11,000 jobs added, but then June came back strong and July came in strong, and unemployment has been holding at 4.9%. Consumer confidence and existing home sales are at good numbers and holding. I think consumer confidence have pulled back a little bit, but it's still at relatively high levels. And then lastly, just to wrap up with the Fed's expectations of the future. Again, the blue dots on here are their votes from their March meeting as to where they believe the Fed funds rate should be at the end of each of these years. And the purple dots are from the June meeting, and then the lines are the median of those respective votes. So you can see that their expected trajectory for the Fed funds rate has fallen quite a bit for 2017 and 2018 and beyond. And then the red line there are the Fed funds futures as of June 16th. And you can see the market doesn't expect to see a Fed funds rate over 1% even by 2018. So the mantra has really become lower for longer. We're expected to see low interest rates for longer than previously expected. We've obviously been in a low interest rate environment since 2008, and it is expected to continue. And even if the Fed does raise rates once this year, which is, I think, our maximum expectation for a potential rate hike, because we don't expect that they will raise rates in light of the coming election, and that leaves December as their only meeting this year, which is a big maybe. And so even if they do start raising rates, you know, inflation's not pushing them to do so. Employment is good, but if you don't have inflation sort of, you know, raring to go, then there's no reason to pull back on the economy. So even if they do raise rates, it's going to be extremely gradual, and even more gradual than gradual meant before. The corporates, just wanted to mention that the Federal Reserve conducted their stress test on the banking industry in the U.S. as required by the Frank-Dodd legislation. And you can see a lot of green here. That really means that banks are very strong. They have a lot of capital. They have the ability to withstand some very severe situations. The scenarios that they are tested under for this examination are, you know, the same or similar or even stronger than those we experienced in the 2007-2008 financial crisis, and not really expected to be replicated anytime soon. Things like 10% unemployment and, you know, a 30% decline in housing prices. So very severe sort of testing scenarios, and most banks came out with you know, really good scores.
Talking about high unemployment and dropping housing prices. They want to be, if that happens, they want to be geared for that.
The green means that they would be okay even in those scenarios. So banks, since the financial crisis, have built up a lot of additional capital, extra reserves, and so they could withstand a pretty severe downturn in the economy without needing to be bailed out and severe loan losses. That's what's happening. Oh, the capital ratio?
Capital and
The leverage ratio? That's just measuring how much, you know, capital they have on the books relative to liabilities, and then leverage is, you know, loans versus assets.
The problem is they're fake.
Oh, we won't worry about it.
No, they're fake. The reason why they're fake is because the way the bank industry works is that when they foreclose on a house, it's not considered a debit until they resell the homes. So that's what politics is going on in Washington right now. Just an example, in Antelope Valley, we have over 12,000 homes in Antelope Valley that haven't made a mortgage payment in 6 years. So those are not showing up on there because we're not foreclosing, because we're not giving them welfare money to go elsewhere. That's number one. Number two is that the foreclosure market has come to a standstill. Not because there isn't houses to be foreclosed on. There's about 7 million houses in America that should be foreclosed on, but there's nowhere to put the people. So these reports we get that come in here, the numbers, is that they're not true because they don't the way the banking industry writes the foreclosure laws, which is sad, is that they do not allow, when they take back a house, it's not considered a negative until they resell a house, because if they take a house back at $400,000, it's still an asset. If they resell it back at $300,000, the $100,000 loss is now a debit. They're not foreclosing. So, and the reason why we know that is because basically is that we have access, the credit industry is now allowed to disclose what's on credit reports under federal law, so the people that are delinquent, there's access, ways of getting access to that is, it's millions. So they sit and live in the house for free. It's not a problem. That's what happens. So these numbers, the banks are slow, they got $1 trillion to borrow, and the problem is nobody's borrowing their money. And that's because you didn't talk about the new mortgage lending laws that just changed in November that prevents the average person from borrowing. Because credit right now, it's very difficult for people to borrow money right now unless you have extremely outstanding credit. And if you need proof of that, I'll give it to you. I got them in my office all day. Okay.
But this is just to, kind of tell you that we think the financial industry is strong enough, for the credits that we're buying for your portfolio, they're being appropriate, strong. We like the financial industry because of the capital and the fundamentals, and also because of the value that we're seeing in the yields relative to other sectors.
The key is all these things we put them in, we've been doing it. It's been going on for 5 years. I mean, everybody would love to see the rates go to 6% on mortgages. Nobody could sell their house. So what it does, it completely stagnates and freezes the entire real estate market in this country. Because if you have a 3.5% mortgage and you want to sell it, take the equity, go buy a house at 6%, they're not going to do it because they're not going to qualify. So it's a catch-22. They didn't realize the Federal Reserve and the government, by going this low on the interest rates, how they get themselves out of this ditch. Then we'll start moving rates.
Well, I think if we'd seen more robust recovery in the economy, the Federal Reserve would feel much more comfortable about raising rates, but as it stands, the recovery has been very sluggish, which is what is expected when you come out of a financial crisis. Recovering out of a financial crisis is historically very different than recovering out of a recession that's 1 or 2 years, like the dot-com bubble or things like that.
You didn't talk about the UN. London, just recently, what happened this last week, by cutting their rate in half. And you didn't talk about Japan, who's offering a 0% interest rate.
Well, those are the reasons that you're seeing negative sovereign bonds around the world.
Right, but you're not mentioning that so we understand what, the reason is our competitive countries in the world, you can borrow money cheaper from them than you can from the U.S. right now, even at 40%.
Well, I don't think that has a direct impact on what we're buying for you. I mean, the treasuries, we have a higher yield here than around the world, which is, great for us relatively. You can't invest internationally, so there's not, there's not really a comparison there. But one of the reasons that we're not seeing more of an uplift in rates in the U.S. is because that demand from outside the U.S. for investors coming here and buying U.S. treasuries because our yields are relatively higher. That's just one of those aspects.
So how do we get over 1%?
I mean, you have to invest in longer term securities, longer than 2 years. Right now we have the 2-year maximum on the maturities, and being diversified. That's the way. Because you can certainly get, one-handle investments and, for a time, two-handle investments, meaning a 2 something yield, but those are in that 3 to 5 year maturity range, and they're probably corporates, which, we think are completely appropriate. But that just hasn't been, the flavor of the board here for a while. So, we'd be happy to talk about that and what that looks like. But that's what we're seeing in the market right now.
Can you give us an example between 2 years and 3 years?
Yeah, if you look at the yield curve, let me go back. So if you look at the yield curve, let's look at the table because it's just easier to see the actual yields. So a 3-year treasury, so not taking on credit risk, was giving you about 0.7% at the end of the quarter, And then the 5-year was giving you a 102. Again, those are really dampened as of June 30. They're lower than they are today. The 5-year was running around like 115 as of yesterday. And then, you know, if you can add 50 to 75 basis points of spread, additional yield on non-government investments, then, you know, you're getting close to 1.5 or 2% yields in that 3 to 5 year range.
So what you just said regarding the government and what's going on today, you look at today's, okay, we go by the orange line, that's the one you really want to go by, the red line. So,
Yeah, that's the closest to
Right.
today, but it's already, you know, yields aren't right there right now.
Well, what I'm saying is that in 5 years, we barely cracked 1%. What's your projections here?
Right, that's what that's saying, you know, having, I don't,
So hang on.
yeah, if you buy a 5-year security as of June 30, you were getting about 1% on
Okay,
it.
so that's what I want you to,
Yeah.
okay, that's fine, wait, okay. And the next question is, does this agency, the reason why we want more than 2 years, it's not worth the risk, because the 2 to 5 years, which is an additional 3, the type of money would be not good for the agency.
The risk reward is just not
It's just
there.
not-
Well,
there.
it depends on how long rates are gonna be low and how quickly the Federal Reserve is going to raise rates. The more gradually the Federal Reserve raises rates, the less you have that sort of opportunity cost offset that you're talking
So
about.
let me ask you this question. In the last 5 years now, let's say last 5 years, we've never gone above 1%.
On your yield?
On these charts.
I don't know your exact yield history over that time, but when we were investing in a 1 to 5 year strategy, you probably got really close, or you could have eclipsed 1% on the overall average yield of the portfolio, but I'd have to go back and look.
Okay, but like you said, the word clip. We might have clipped that 1%, okay? So what I'm trying to show the board here, it's the last 5 years. We look at the next 3 years, okay? That's 8 years. And by tying that money up in that period, we still, for the risk that's involved, we're not making that much more money for the time.
No, and I understand what you're saying. You're talking about projects that are outside the scope of an investment portfolio with your cash assets. What PFM has the ability to manage and purchase for you are the investments that are allowed per your investment policy and per the California Government Code, which are short-term, high-quality, fixed-income securities. So it would be the board's decision to, you know, do something else with the funds rather than invest
Well,
in a
some of it we
portfolio.
can't. The thing is, I don't think we can go outside much than what we have right now.
You can't, I mean, the decisions that you could make within the California Government Code for an investment portfolio like this are going out to 5 years. You can elect to go out past 5 years. You can make a special decision to do that. I'm not recommending that, especially at this point. And you can have a diversified portfolio. And there is room in your policy to, you know, add exposure to things like negotiable CDs under 2 years. That would add some yield. It's not a silver bullet, but it's something. But then, you know, as you were saying, if you chose to do other things with the district's money, like lend it out, that's outside the purview of an investment portfolio with your cash assets.
What's the, on CDs right now, you left it for a year, 2 years. How much, what is the ICD you see on those?
Well, in that 1 to 2 year space, like I said, you're seeing about, you know, depends on the issuer, depends on the credit, you're seeing somewhere in that 50 to 75 basis point of additional yield. So if you look at, you know, we're a 1 to 2 year here, so you're looking in the 1 to 1.5% range.
So if we invested $20 million, we're gonna see somewhere between 0.5% and 3/4%.
Of additional return over a treasury
Right.
or yield.
Right.
You can read those at your leisure. But just to show you the makeup of the portfolio as of June 30, it was very diversified. You know, over half the portfolio was in treasuries and agencies. As I discussed, you have some negotiable CDs, you have some commercial paper. Commercial paper and money market securities have been providing a lot of value in the under 1 year space because of the coming money market reform. prime money market funds are going to either go away or be converted to government money market funds because they don't want to have to float their share prices, which kind of just changes the whole characteristic of what a money market fund is. And so they're going to stop purchasing non-government money market securities like commercial paper and negotiable CDs. That demand that's going away has pushed those yields up and prices down. And so that's why we're seeing good yields on negotiable CDs and commercial paper. So we've seen a 4% increase on commercial paper in your portfolio. You continue to own a good portion of corporate notes, and that brings your whole portfolio to about $26 million.
So are they taking away privatization or forcing us to use more government direction when it comes to bonds?
No, this is just direction to the money market fund industry. Coming out of the financial crisis, there was a money market fund that broke the buck, which means that it could not provide a dollar for every dollar invested, which is really the main characteristic of a money market fund. And so there were changes made in 2010 by the SEC for the rules for money market funds, and then they've taken it a step further, and this year are implementing a second round of new rules for money market funds. And the biggest change is that prime money market funds, those investing outside of treasuries and agencies, have to provide a floating share price. So if you put in $1 and rates move up or down, you may not be able to get that dollar out. It may be more than $1, but it could also be less than $1. And people have really, and institutions have really used money market funds for principal preservation and some interest. And that principal preservation component, was never guaranteed, but it's really going away as a concept for prime money market funds. And I don't think a lot of institutional investors or retail investors have any appetite for a floating prime money market fund. So you're seeing a lot of those funds just leave the market, get converted to government funds, and so there's not as much money chasing money market securities anymore. So that's why that demand supply dynamic has kind of changed in that value component. Most importantly, the portfolio is in compliance with your policy. This is a new page in our quarterly report format, which I really like because it gives you a very quick, high-level snapshot of the portfolio. The credit quality by S&P is the left-hand pie chart. The sector allocation is on the right as a pie chart, and then you can see your maturity distribution. And you can see the portfolio is all under 2 years at this point. So all of the, we kind of have this organic shortening of the portfolio. We didn't actively sell things to bring the portfolio under 2 years, but now we've reached that point where all the investments are under 2 years.
Okay, the prior slide had 25,900,000 at the bottom.
Yep.
Okay, total. Mm-hmm. Okay, and then the next slide you show. Because
it includes your cash. So if you added that 30,000, and I think the accrued interest, the market value, yeah, the 26,067. This here does not include the accrued interest. You have to add the accrued interest in. I'm sorry, one back the wrong way. It's broken out on the other page. Yeah, this number here, where it says total market value, includes all those numbers below it where the where it says security market value, accrued interest, and cash.
So in that you've got the par value, which means that the same like we sold earlier. Some of these where you pay 110%, they get 100% if we don't keep it in time.
Well, your market value is higher than your par value, which means that you would have gains when you sold it. Which, as we have changes in interest rates, we have that inverse relationship between yield and price. So as yields were falling in the second quarter, we had market values going up. So
one last Teresa question. We talked about this in the finance committee, so why don't you explain, you know what I'm asking about?
Yeah, what you're looking at is par value compared to purchase price, which purchase price isn't listed on this page. So we can't look at that comparison here.
Yeah, you have original cost in the details of the monthly statement that we provide. It's just not one of the statistics we provide on this page.
But I just wanted to give
Yeah,
that
yeah.
comment to the board. Will you explain that to the board, what that means?
If we don't hold the investments to maturity, if we were to sell them or were
Sure.
forced to sell them, we could potentially, if we're paying premium for investments, we could potentially realize less than what we paid for them.
On the principal, but you need to look at the overall earnings of an investment to see whether you made money on an
No,
investment
that's
or
what
not.
you're saying. That's all I'm saying. I know you're saying maturity. We're not talking about maturity. We're selling them short. So if we go and sell something before we go out to.
Oh, no, I mean, if you sold it before maturity and took a loss relative to original cost because you bought something at a premium, it doesn't necessarily mean that you lost money on the investment. You need to look at the income, the coupons, over the life of the time that you held the investment as well. And that total amount of income, you would offset the loss with the income. That's your earnings on the investment. So when you buy a security at a premium, it simply means that the coupon is higher than the yield. It means that when the investment was...
Slow down. But it's not worth that when you do that. If I'm buying something.
No, it's not worth the coupon, it's worth the yield. The yield on an investment
Right.
is what you make.
Right, but if I had to pull that money out in 3 months, and if I put $1 million in it, why wouldn't you give me back $1 million?
Well, if you bought something at a premium, let's say you bought it at 105,
Right,
and it's now a year later, and it's, you have amortized some of that premium down, and now it's worth 104, because at maturity, you're gonna have the same problem at maturity. But buying something at a premium is not the problem. The problem is how you view the accounting of the investment. A premium, you're gonna realize that premium, and the reason you realize that premium is because it's there to offset the coupon so that all you earn on the investment is the yield. And that's simply because it's not worth the coupon when you buy it. That's not a bad thing, it just means that's where the market is on the day that you bought it. It means that that security was issued in a market, came to market than the primary market on the day it was issued, and the yields in the market were higher at that time. And we've been in a falling interest rate environment, so premium securities, there's a lot of it out there.
That's 100%, you're correct, but we still don't want our purchase, our value to be less than our purchase price.
But that's an accounting issue, it's not an investment issue, so you really don't want to
Well,
dictate.
if you were to sell it, people don't strive to be.
But you're gonna have the same issue at maturity, because if you don't
No,
amortize.
you've received an additional income that you wouldn't have ordinarily received.
Right, but if you sell a premium security before, either at maturity or when you sell it, what you bought the security for, you're not gonna get back.
But the only way it would go down is if other rates would have went up and you would have lost opportunities.
Yes, but that's a market move, that's not the premium
It's market,
itself.
but it seemed like for a long time, we've had differences of opinion. We're to make money and not to lose money. So if that was to happen, if you buy something at a 2% and all of a sudden the rate goes up to 3%, you're gonna lose money on that investment, because why are people gonna buy your investment if they can buy another investment higher? So nobody strives to do that.
No, but that's
We're
why
trying to-
you
we're trying to
manage.
we get it back, and we do get some of it back in return, but not as much as if we'd had a different current investment. It would have been an economic rate.
Right, but that's a different issue than buying something at a premium
Oh, yeah, that's correct. You're
than
correct.
the market moving.
Premium is not always bad.
No, a premium is not ever bad. You can buy securities at a discount as well. It just means that the coupon is less than the yield. Again, it was issued in a market where yields were lower, and now yields have risen, and so it's worth more in the new environment.
Maybe you could do a demonstration for us in the future.
Yeah, I can bring some information.
Dollar amounts and what it would have been.
Yeah.
and
I think
premium or not premium and
yeah.
so,
Teresa has that.
because that should explain it really pretty simply.
Yeah, and I think the most important concept to understand is that whether you buy a security at a premium, at par, at 100, or at a discount, the holding period return and earnings is the same, regardless of whether you sell it before maturity or hold it to maturity. That, I can demonstrate that. And that's
And that's true, but that's not the issue.
Well, that's the issue that Frank raised. But I understand your issue, and that's why, you know, we're following your instructions to keep the maturities under 2 years, because the board has decided that it's not comfortable taking interest rate risk beyond 2 years. We've been working with you guys, but, you know, if you put additional restrictions, you remove flexibility and you remove potential. But, you know, I've had other clients who have made decisions to, you know, pull back on the amount of interest rate risk they're taking, lower their average maturity or average duration to limit that exposure because they see the same thing that you do. The problem has been that over the time that we've been doing that, there's been a lot of return given up. But we just need to be comfortable with that and stick with the decision that we've made, or decide that we're not willing to hold out any longer because we know that that lower for longer is still out there. But, you know, we're happy to take your instruction and roll with it. So the other new statistics on the left-hand side there are pretty helpful, giving you your different yields, your yield at market, which is where you could have sold the whole portfolio in the market if you needed to as of June 30. The yield at cost is what you are earning on the portfolio, and because we purchased your investments when yields were higher, you have an unrealized gain in the portfolio. You're earning more than the market is yielding today, so it's a good position to be in. As rates start to rise, those could flip-flop. The effective duration on the portfolio and average maturity is right around a year, and your average credit quality is a AA, because we're showing you the Standard & Poor's credit ratings, and so all the treasuries and agencies are rated AA plus by Standard & Poor's now. Here are the returns on the portfolio. As I said, the duration was 0.97 years. For the past quarter, the portfolio earned 0.32%. That is an unannualized number. That's just for the quarter. The other numbers there are annualized. So you earned 0.97% for the past year. You earned 0.9% for the past 2 years. And since inception, been right at 1%. So almost there, Frank. Almost there. This is another new page here on page 17. These are your dollar earnings for the quarter, and you can see here.
Can I stop you for a second?
Yeah.
That 1%, does that include, is that before?
That is before.
After we paid you or before we paid you?
That's before, and your fees are 10 basis points, so the net return would be 0.9%. So this shows you the earnings on a market value basis and an amortized cost basis. And you can see that your portfolio earnings on the market value basis are a little bit higher, and that had to do with the market value gains in the portfolio. And again, that negative that you see there, change in value on the amortized cost side, that's not a loss. That just means that we were amortizing some of those premiums that you're seeing in the portfolio. You need to write those down every month so that you don't take a loss, you know, at maturity. 18, here we're showing you the sector allocation over time, so you can see how dynamic the sector allocation of the portfolio is. You can also see the growth in the portfolio size. So from September 30th of last year through June of this year, the portfolio has grown about $600,000 in market value, and you have a larger allocation to treasuries, and the allocation to federal agencies has shrunk as issuance has shrunk in the federal agencies that we buy for your portfolio. And you're seeing a larger allocation to commercial paper for the reasons that I mentioned. And then you can see your issuer distribution. The thing I would point out here that I really like is that we show you the top 5 and the top 10 in the bar on the right-hand side. And then you can see that your top 2 issuers in the portfolio are government, you know, treasuries and agencies. And then you can see that there's no more than 4% in any one non-government name, you know, which is really a risk management tool that we utilize to protect the portfolio from having too much exposure to any one non-government issuer. And there's the last of them. And then you've got the holdings at the back, as we normally. Any other questions?
There are two things I'm going to talk about. In general, I'll talk about in the presentation about the Integrated Regional Water Management Plan altogether. And this started back in about 2007. AVEK was asked to join an integrated group to talk about water supply in Antelope Valley, and also talk about projects that could be proposed to help water supply, to help water reliability. And in doing the Integrated Regional Water Management Plan, and building that and submitting that to the state, we're able to get state funding from the Department of Water Resources for these projects. We've been fortunate, as I mentioned in the Finance Committee, we've only put in about $5,000 since this began in 2007. And since then, we have gotten Proposition 84 Round 2 funds of $5.4 million. So it's been a great return on our investment. So several people have put into the program. There are 11 different entities involved in the regional management group, which funds this whole process. Los Angeles County Water Works has put in the largest amount of money. So between a group of 11, Los Angeles County Water Works put in the most money, and they've also honestly have done the most effort in getting the meetings going and keeping it moving. Now, as we moved into 2014, a new Integrated Regional Water Management region came about that had not developed a plan. That's the Fremont Basin, Fremont Valley Basin, and they're just to the north of us. And so that's kind of where our focus is tonight, because the bills that are related to the Integrated Regional Water Management Plan are for that region, not for the Antelope Valley region. So I'll move forward in this and just show you a little bit of background. As I mentioned, the program overall, Integrated Regional Water Management. I'm going to call it IRWMP for short because we affectionately call it IRWMP because it's very hard to say. So the IRWMP process started back actually for the Department of Water Resources back in 2002, and it was to again encourage regional cooperation between entities and create plans for managing local supplies. Also supporting the projects which I mentioned for water quality, quantity, reliability. And this is key, making regions eligible for state funding. The state said if you're going to seek state funds, we want to know what you're doing, and we want to know that you're cooperating with others around you. So they created this IRWMP process. There are 6 regions in our Lahan funding area, and they're competing for grant funds. You can see the local IRWP regions there that we're going to talk about tonight, and that's the Antelope Valley, those two at the bottom, the Antelope Valley region and the Fremont Valley. So we are included, Antelope Valley, Fremont Basin, Tahoe, Sierra, Inyo, Mojave region, and Lahontan Basins are all included in what's called the Lahontan region, and that takes up North Lahontan and South Lahontan. These are what these areas look like, aerial view, just to give you an idea. There's the Antelope Valley. Antelope Valley region is in the red there, and then the newer Fremont Basin areas in blue. And just to give you an idea what it looks like with our boundaries, that's what it looks like. So we are, the reason why we are involved in both of these regions is because our service area covers both of these regions, and we have customers in both regions. A little bit closer up, just to show you what we're going to focus on tonight is this Fremont Valley Basin area. As you can see, the AVEK service area does go into this region. We have areas like Mojave, which although the city of Mojave, this was mentioned to finance, although the city of Mojave looks like it's outside of the boundary of the Fremont Basin, it is actually pumping groundwater wells from the hydrological region of the Fremont Valley. So it's pumping wells from the north and bringing them down south. So you have customers of ours like Mojave, you have California City, but there are also other outlying areas like Cantil, Randsburg is in there as well. The new IRWP program, this new one was formed, as I mentioned, in 2014. There was a regional water management group that was put together, which was created by a memorandum of understanding. It was created between the three shown there, City of California City, but it's really taking the lead in this Fremont Valley portion. Mojave Public Utilities District and AVEK. Here's a list of stakeholders. These are folks that have shown up at the meetings and have interest in this region. The three in red are the regional water management group that's helping to fund this effort. The initial plan is expected to take about a year and a half to complete, so we're hoping to have that done by next year. Estimated cost is about $500,000. To give you an idea, in 2007, the original Antelope Valley plan cost about $800,000. That gives you an idea, but that was back in 2007. In this case, there's a very low local match required. In fact, there may be no local match required in order for us to get grant money, which is great news. The funding that's currently available that we're going to look at, and we will be seeing a lot more of this in upcoming months, is Proposition 1 water bond funds. The Irwin process through the water fund is going to be able to have available to it $510 million. That is allocated amongst the 12 areas shown there. And there will be about $24.5 million for the Lahontan region, which is that region there. There are 3 grant programs that are being offered through the water fund. There's a planning grant program, which would basically be funds available to actually develop the plan. There's also implementation grant programs. That is funds available to build these projects that the plan is referring to. And then there's economically distressed areas, or DACs, they call them disadvantaged communities. And if you are involved in those areas, then they have special grant funds just set aside for you.
We have any area.
In our area, yeah, we have a little bit of that. We have a few small areas in the Antelope Valley region, and all of the Fremont Basin is basically declared DAC. So the planning grant program is what I'll look at first. The final guidelines, they just came out last week, and they upped the per grant maximum to $1 million. So that means they'll put $1 million to one particular region's effort in putting in and creating the plan. The group hired RMC kind of on an as-needed basis. RMC Water Environmental. They were hired in September 2015 to prepare the planning grant, the application to help support this group, this new group that formed, to basically put together stakeholder meetings and the like, to communicate also with the Department of Water Resources for us. The planning grant is to be completed in August, and so that's very close to being completed right now. Now, the other thing we'll mention, and this is also one of the invoices we're going to look at tonight, is the economically distressed areas, or DACs, they call them disadvantaged communities. And 10% of the overall funds that I was talking about for the Irwin process are allocated to this region. But the department says, but you have to be cooperating amongst each other in the Lahontan region. So what has happened is there's now a Lahontan-wide effort for everyone to get along to go after these DAC funds. And so Lahontan has basically put eNEWS up to the front because of their experience and because of they have a lot of knowledge in their consultants that work on these projects. And so eNEWS has hired this Eastern California Water Association, and they are the leaders basically in heading up this disadvantaged community, or this area of the farms. So what's happened is this new region has gotten together and has all supported eNEWS taking the lead. And what they're asking for is for their staff to be able to continue to do the work and finish the work. They're asking for $4,000. And this is basically between, it'd be $4,000 for the Fremont Valley area, so AVEK share would be a third of that. And all of this is reimbursable with grant funding. So if we get grant funding, which we are expecting to get, it'll be reimbursed. So the current invoices that are also shown in your packet are the planning grant program, which I mentioned. This is an invoice from RMC for their services. Their work through March through May of this year. Current contract finishes in August, or when we have our last stakeholder meeting, whichever comes last. AVEK's share of this would be about $2,600, which is just 1/3 of the total.
I'll make a motion on order 682.1, pay the amount of $2,626.50.
I'll second.
Any more discussion? All in favor indicate by saying aye.
Aye.
Opposed? Carried.
It's the board, this is the general manager report for August 9th, 2016. With regards to water supply, our allocation remains at 60%. Lake Corville, as you would imagine, is being reduced to a certain extent in that graph that will show this to you. San Luis is up slightly, not as much as we'd like to see, but it's there. You know, this Feather River Basin is dry, and your temps are going to be average. I'll show you a slide pretty soon that shows that the next 3 months is going to be pretty dry. So here's some 3-month outlook with regards to temperature, and you can see that we're pretty warm all through the areas of the state or the country for that matter.
It's like one big flame.
One big thing, yeah. And you can see that we're below normal in precipitation in our particular areas. So, things don't look real good for the next 3 months. But who knows? Here's our reservoir conditions and the 2 important reservoirs for the eNEWS. You can see that Orville's is below average, and San Luis is significantly below average. Here's our Northern Sierra Precipitation Station Index that we look at every month or every meeting, I should say. You can see that we've flattened out with regard to precipitation. Based on that 3-month outlook, it's safe to say that we're going to end the year pretty close to 57.8% or inches of precipitation, which is above average for this region. Not as high as it's ever been, but not as dry as it was a while back. Here's your reservoir, Lake Orville. You can see it's on its way down, as you would anticipate, with another robust season of storage. And here's our St. Louis reservoir storage, and you can see the Bureau share is dwindling, as is the DWS share, so pretty low. Have no problem with spillovers for sure. With regards to our own operations here, you can see Quartz Hills, we're running about 50% capacity at 48 million gallons a day. It's up from last year. You can see our Roseman is pretty consistent, T-side the same, and also our connection with pumping water distribution is the same. And the reason for that is that our west side of the water bank pumping is we've reduced that. We put the state water supply. As we talked about the west side wells, we're down to 1.3 million gallons a day with regards to them. Going over to LA County Water Works District, our east side banking and blending project, we're going to start recharging again after we do some maintenance work.
So what?
Maintenance work on the ponds that we have there. Once again, we're in our testing process and making sure that the system is working well. We're also beginning to rotate those new wells so that we can put that water, pump it back into the canal while our permit is being prepared by the State Water Resources Control Board, so that we can actually get this water over to our east side water plant and get it delivered out to the east side of our service area. We've been just putting between 1.5 to 5 acre feet a day supply as far as pump back goes. So we've been testing it to make sure that it's fully functional and will do the job that was intended in the contracts that have worked on. So everything's working very well at the present time. Our water quality remains stable at all of our testing sites. The next THM results will be on August 18th. We hope to update our water quality graphs at that time. Some news from Sacramento. The California water fix point of conversion periods began last week. The Department of Water Resources is having several weeks of hearings to determine if they were going to allow for the point of conversion change for the water fix to move to, and that's going on at the present time. Another significant area is that Governor Brown has decided to delay the electrical grid legislation to expand the ISO California Independent System Operator to the western states. There was legislation that was required in order to be able to accomplish that. It's a goal of his to expand the network that California has to cooperate with the other 7 regional states and form this larger group. There is great concern that California will lose some control of its own electrical distribution system, which may increase our costs. It's interesting that in light of the previous Enron type of deal that we had a few years ago, close to 65% of the power that is generated in the western states is all done by Berkowitz, Hathaway, that group owns a lot of those electrical plants, and so there's concern by some that we may be in that monopoly kind of thing, and prices might go up. What are the assurances that if we went ahead and did this, that it would work out well? Part of the reason why the governor would like to accomplish this is to extend the clean power that California is producing, to allow that to be distributed to the other states. At the same kind of outlining that, and then many of the environmental groups in California are concerned about us buying dirty power from the coal plants that are in the other parts of the western states and bring that in. So so with all that in mind, he decided to not pursue that at least for several months, and to continue to work on that. But it has a direct impact with regards to what our distribution costs are going to be for the power. And as distribution costs go up, so does our costs. Yes.
Do you know if the other western states are less than
no, they're not the same.
Washington, environmentally Washington and Oregon, they told him to jump in the lake. That's funny because because what his ideas are and what reality are 2 different things. 82% of our power in California comes outside our state.
So it'll have a significant.
In Washington State, when we get off of Bonneville Dam, have they ever functioned up? You got to go see that. It's amazing.
But that's not green.
Huh?
But that's not green.
Well, we know it's green, but the governor's crazy. He wants to shut down Bonneville Dam. Yeah, he doesn't like hydroelectric plants. He thinks they're bad. Do you know if you have in the state of California, you'd go absolutely bankrupt. Literally bankrupt. Overnight. Yeah, hydroelectric plant, he hates it.
I also wanted to make you aware of, in the past round file, there's a request from the Defenders of Wildlife, the Natural Resource Defense Council, and the Bay Institute to have the State Water Resources Control Board they want to demand that the Resources Control Board adopts emergency regulations to increase the outflow to the ocean for protection of the smelt. And there's a letter to that.
Several instructors were up in Washington for a conference. And Ray Davis is in office. And the governor got up, the spokesperson, and said that California's in the room, that I told your governor 2 years ago to make a deal, and he wouldn't do it. And the price of kilowatts went from 9 cents to like 16 cents a kilowatt. That's why you got recalled. Yeah, you got me, I mean, we were there, so we couldn't believe what he was saying. They was going, what are you talking about? We don't know anything about this. Yeah, it was, because that's the same thing with Brown was trying to do.
Some status and updates. We have a Water Master Board hearing on August 17th at 2 p.m. in Lancaster. The state water contractors, AV state water contractors meetings that was scheduled for Thursday has been canceled. So you can take that off.
What happened?
They canceled the meeting on Thursday.
Next week?
Yeah. No, this week. Antelope Valley State Water.
Oh, okay.
And staff and some directors attended the Aqua disaster preparedness event last week. And I'm back from vacation. I'll be around. There is the state water contractors are dark in August, so we don't meet. And so I'll be around the rest of the month.
And I think it was really nice that we had staff there and see some of the changes that we need to make sure that we're in a good position in case of an emergency. So that was good.
Did we find some deficiencies in our procedures?
Yes.
Okay, that's good enough.
Well, did you know this business sitting on the ball?
Neil, do you have a report? I have several things, so I got categorized. So good news or bad news? Andy and Elizabeth say hi. Saw them for the Veterans Conference. They're going pretty good. Andy's having a little bit more time walking the park, walking around and listening to it well. So that was the good news. That they all said hi. Bad news is condolence to Holly for the loss of her grandmother at the young age of 102. So I guess that's that. The trivia is, and Mike can help fill in on it, George and I and Mike were at the National Regional Water Association meeting up in Sun Valley, and some trivia comments that came out that had Mike and I and George kind of all looking confused on here, so I'll try to do them all. An engineer from Idaho and the House Speaker from the Idaho legislation said that basically their groundwater was declining because they stopped doing flood irrigation, because the flood irrigation was recharging their aquifer. So going to sprinklers and being efficient was actually detrimental. And I don't know, Mike's an engineer, we got an engineer. I haven't figured out how pumping 8 in and getting 6 back is any different than pumping 2 out and using it, but that was the main reason for the decline in their aquifer. So that was number one.
Is this sort of what you're saying is they want to use more water?
Yeah, because then they'll recharge the aquifer. Less going down the river. I guess. Then we had a speaker from the Texas Water Plan Financial, which was right at line with what we were kind of interested here. Texas took out $2 billion out of their state emergency fund, rainy day fund as we like to call it, and by voter approval, and gave it to the Water Plan Board to loan money to people within Texas to do water projects. And the money that they earn goes back to that group to refund more plans. And so they are going out on a state level and using the state leverage on bonding to get low rate, and then on top of that even getting a more discount rate in order to do everything, and there's still kind of an integrated regional water plan process that they have to go through, but as a self-sufficient enterprise fund in Texas to do water issues that are voted on by these general election. So, and then, so you hear about $2 billion from them, and we just heard about $24.5 million from Lahontan to do water deals, and the president put in $23 million for water plans and projects in the federal budget. So the federal budget only has, or EPA water sense is $23 million. Lahontan has $24.5 million, and Texas is putting in $2 billion. So it kind of gives you a little bit on it there. Again, following up the report there,
We heard a sob story from the city of Sacramento, basically saying they were losing all their water for outflow for the fish. And they were the worst state of everybody in the state of California because they were losing water out of Folsom Dam for fish.
That's a shame.
So that was their biggest complaint.
All you do is knock on next door, the governor's sitting right there.
Well, now they're wanting to tap into another river to do their regional water plan.
So is that the next one you guys are going back to the board to buy into?
And then the kind of the last one, going back to Idaho, the House Speaker of Idaho talked about Idaho's water plan, state water plan, and we're going to go into 19 areas in there. They spent a lot of time talking about that his family had farmed since the 1800s, and he had senior water rights, and how important those senior water rights were, and how they had to take junior rights from other groups, so they got really tough, and on and on and on. And then he finished it up saying, basically something, I don't have a good quote in there, but we need not to hold on to the past in order to make this water plan work. But I don't think that means giving up his senior rights.
Yeah.
In order to hold on to
Everybody else needs to give up whatever they have.
Yeah, that's all I have.
So
So,
he's asking for all the juniors to give up their water?
water, yeah, but we need not hold on to the past.
I bet it was pretty clean up there.
No, it wasn't.
No, was it hot?
No. We just had out the ice
We
rink.
do that here, whatever it was, they had to bring in portable air conditioning, just because those places have air conditioning, it was so hot.
That's all I have.
Thank you, Neil. Item 10, the authority previously given direction to complete the acquisition of these two parcels that are identified in the resolution, and those parcels are ready to record, and this resolution would complete what's necessary in order for us to go on those two parcels that are located in their place with water area.
I'm going to approve.
Second. Any further discussion? All in favor indicate by saying aye. Aye. Opposed? Approved. Item 11B, adoption of resolution number R1622.
Yes, these next two resolutions are associated with the clean renewable energy bonds, which are required to complete our solar project. These two resolutions are fairly procedural ones. The first resolution is going to indicate that we're going to use the money if we go ahead forward with the bonds to pay for the solar project, use it for some other purpose. And the second resolution designates the two professionals that we would use in order to facilitate the acquisition of bonds. That would include Michael Everett, which we used before, and also our attorney, which our bond counsel, which we used for previous bond issues that we had. So,
Oh, Mr. Anderson?
Anderson, yes. And it just doesn't need those two. It's very simple. Staff will recommend approval.
We have- Thank you. Any more discussion? All in favor indicate by saying aye. Aye. Opposed? It's approved.
I'll move on to
Any more discussion?
Tell me, you're actually gonna
I-
to run for, and you were gonna tell me some of your credentials.
I graduated with a degree in environmental resource management,
Oh,
so it fits in well with the water, and I've been around it for my entire life.
yeah, and where did you graduate from?
Cal State Bakersfield. I transferred from Cal Poly after my grandpa died to help with the family business.
Uh-huh,
Environmental resource management was the closest to ag business, and so it worked out, and that's ended
uh-huh,
up with that degree.
sure. Well, that'll stand you in good stead here, I think.
Yeah. So All right, I'm going to talk to my dad here real quick and
Take care.
call my wife and have her come pick me up.
All right, good.
All
Best
right.
of luck.
Thank you.